Hey, welcome back. We see WBD recovering quite a bit from the recent lows, but as you are about to see, there should be much more potential. Last quarter and year were actually pretty good and the market really liked it. Everything was flat or slightly down, but the market paid more attention to the growth in DTC, where the company added like 20% more people year over year. And that's the thing with a stock valued at such low expectations. You can have an okay, far from amazing year and you don't really need that much to see the stock go up. From my point of view, what's important is that they kept repaying the debt and now got to 40 billion in gross debt, meaning a 3.8x net leverage. So that's a 4.2 billion gross debt reduction over 2024. For a reference, they target a net leverage of 2.5 to 3 in the long term, after which they can probably get into massive dividends and buybacks, but more about this later in the video. Also very important for me is that they managed to make 4.4 billion in cash flows this year, which even if it's down after a good year, is a ratio of around 6, which is very good. And that's even with the stock going up recently. So overall quite a good report and definitely shows the company's potential. Not only that, but the market is starting to be more and more aware, which as I'll show later, is pretty much all that the stock needs to be very profitable. They can make 4, 5, 6 billion per year, which is an amazing amount for a now 25 billion market cap. Netflix, for a reference, is a 420 billion market cap company that makes like 7 billion per year. But on the other hand, you have AMC Networks at 420 million making like 350 million, so it's very different. Back to WBD, it can vary quite a bit because have a couple of successful movies, maybe a game as well, and that can be another billion just like that. Financially, we see an okay position with the current assets not covering the current liabilities, but it's a matter of cash flows and timing and stuff, and if needed, there is short-term credit. Again, the market generally looks at the debt, sees a big number and instantly assumes it's bad. I've seen comments like that even for companies that barely have debt given the size. It doesn't matter that they make enough to cover it or that it's spread over decades and comes at an okay interest rate. Again, it's the same for AT&T. They don't have to pay it all at once, and in fact they'll never repay everything and be in zero debt. Probably the biggest opportunity for them will come from repaying the debt. That's easily another billion in interest that they can free up, and also keep in mind the effect of rate cuts, plus the effect on the market's opinion about the company, leading to them potentially getting even cheaper debt in the future. After that, they can focus on dividends and buybacks, so even more potential to attract the market. Now, they also talked about looking into spin-offs or anything that would unlock some value. They can indeed do what AT&T did to them, which is unload a lot of debt and the solid side of the company and be left with maybe just the Netflix equivalent. I think if they want to, there is potential to split into the slow and steadily declining cash generator and the higher potential mechs, gaming studios and so on. It's too early to assume, but the moment they announce anything, if they do, this is very likely another jump. So there is always this underlying catalyst that can come at any time. Another actually impending catalyst that's more about the market's opinion is the amortization falling. From what I saw, the market pays way too much attention to the company's profit without necessarily understanding everything behind it. It's negative, so it's bad, some people don't take another look. And again, you have to think about who owns or owned WBD shares. A majority of people after the spin-off were AT&T shareholders that got, not bought, WBD. I have some AT&T that I bought at a very good price, but this is the classic slow and steady dividend retirement stock. When these people look at WBD and see a negative profit, falling prices, no dividend, high debt and so on, they probably don't want it. Even treasuries were paying like 6% and many other dividend stocks on the market were paying even more. And some people indeed can't wait half a decade to maybe see a dividend from this if they manage it right. They depend on that money. Not to mention that they got an uncertain asset that they had no idea what it can do at an actually pretty high price, so we can't really condemn them. Now, however, as they repay the debt and keep disproving the market's arguments, they started getting some attention. And I want to mention again that they have the potential of being bought entirely by a company like Apple or Amazon. It would save so much money for them if they have all of WBD's IPs, and especially as they repay the debt and the market cap doesn't increase, they become too cheap to ignore. And when you think about the roughly 60 billion enterprise value of WBD for a potential buyer like Apple or Amazon, that's a 2-3% dilution. In return, they can increase the cash flow by like 5-10% immediately, plus the potential synergies and other things they can develop. So there are quite a few potential catalysts that also basically counter pretty much any argument that the market has. But there is always risk, especially if they get greedy and focus more on the stock than the company and ultimately mismanage it. Not to mention the competition and potentially falling margins as a result, plus the already falling cable business. Again, they are fighting Netflix, Apple, Amazon, who have a ton of liquidity, and if they don't buy them, they are tough competition. But again, we already see interest from Disney through that bundle, so keep that in mind. Now let's see a valuation. In a bad environment with high competition, rapidly falling cable business and other issues, let's say they make 3 billion per year. That's, by the way, around what Discovery alone was making before the merger. For a ratio of 5 like today, that's a 15 billion market cap, meaning a price of 6.11, so a drop of around 40%, very similar to the low from not even half a year ago. But then repaying the debt and lowering the interest would increase the cash flow, but even 3 billion would allow for some very nice dividends and buybacks. Half of that would become a 10% yield, so you see what I mean. Now, in a second scenario, let's say they get to 4.5 billion per year to account for cable decreasing and Max and the rest reaching maturity. Say the market is trading them at 10 times that amount, which is again very low in this industry, and that's a 45 billion market cap. That's a price of 18.34, meaning pretty much an 80-90% profit. If they then do some dividends and buybacks, that's easily a 2x. Even half of the cash flow is an 8-9% yield for the current price. In a better scenario, let's say they repay the debt, Max is developing well and even offsetting a potential loss in cable, and they stabilize at 6 billion per year. If the market sees much less debt on the balance sheet, the company doing okay, developing and constantly making good money, let's say they get to a ratio of 15. It's not even much in the industry, but that's a 90 billion market cap, meaning a price of 36.7, so almost a 4x. Not only that, but as they repay the debt, they free money for dividends, which could easily get to double-digit yields. And if the market doesn't react, they can do buybacks and simulate some demand. By the way, I use the market cap because that's what we pay as normal people. I know some people asked why I don't use the enterprise value instead before. If I was a buyer like, say, Amazon, sure, the enterprise value is much more relevant. Until then, they keep repaying the debt, which decreases the EV, but it can also increase the market cap at the same time, so it's not as relevant for us as it may seem. You know, the market cap and thus the price could double and the EV could be the same as they repay the debt. We don't buy it debt free, we take that into account when we decide what market cap or equivalent price to buy it. It's a good metric to compare with other acquisitions in the industry, but not that great for our valuations. It's an additional step from the market cap and adding even more uncertain variables. So I like and I own some WBD, and I think it still has potential, especially as they repay the debt. That frees money that would have been used to pay the interest, resulting in higher cash flows that they can use to repay even quicker and eventually snowball into a great cash flow producer. They can then pay a massive dividend, do buybacks if needed, invest, so the potential to attract the market is even higher than just improving the balance sheet. And as they disprove market arguments and continue the debt repayments, look into spin-offs and so on, the stock also follows. Overall, they can make a ton of money that they use to improve the balance sheet, which can really change WBD in even less than half a decade. There is potential from Max, gaming, a spin-off, and even being bought entirely by another company, and I think the current price is still okay for me. I have a pretty significant position already, around 7.85, but if I get the chance to develop it more around that price, I'll definitely do it. At the end of the day, it's about the risk and reward you are happy with. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.